Okay, so NPV is basically net present value. NPV is one of the method of investment appraisal. And what does NPV tells you? NPV method of investment represents a net benefit or net loss from an investment opportunity in the present value terms. So NPV tells you how much of net benefit or net loss you are getting from investing in a certain project in present value terms. Present value terms means today's term. Like let's say for example, if I invest $10,000 today and I am gonna get $500 every year, sorry, $5,000 for 3 years, for example. So now if I want to see whether I should go with the project or not, I will see what is the present value of the future cash flow that I am getting from the product. As you know about the time value of money concept, that with time, the value of money falls, right? And you can convert those future values into the present values by multiplying that with discount factor. So similarly, you will do whatever the future cash flow, future net cash flow is from the project that you are getting, you multiply that with a discount factor to see what's the value of that cash flow today. And whatever the values are, you will deduct the initial investment from them to see whether you are getting net benefit or net loss. Okay. So the formula of NPV is in front of you. Present value of future net cash flows minus initial investment. So whatever you are getting from the project, present value of that minus the initial investment. If your answer is positive, it means that you are getting benefit from the project. You will go with the project. If your answer is negative, it means that the project is giving you the loss. So you will not invest in the project. Okay. Second point is that you only use relevant cash flows. This concept I already told you, that while you are doing the appraisal, investment appraisal, you consider relevant cash flows only. And relevant cash flows are those cash flows that arises because of our decision to invest. They are basically future incremental cash flows. So those cash flows that depends upon my decision. Okay, if I say that I will invest in the project, that cash flow will occur. Those are known as relevant. If I say I won't invest in the project, and uh, then that cash flow won't be occurring. Okay, we don't need to incur that, we don't need to spend that. So because that cash flow depends upon my decision to invest, so that will be the relevant cash flow. Irrelevant is which does not depends upon my decision. Okay, let's say for example, for investing in the project, I did some research and I paid $10,000 for that research purpose. The project is a huge $1 million project. So now I spent $10,000 research cost on that. Now the research cost is already spent. Now whether I invest in the project or I don't, this cost is already spent. So this cost will be irrelevant for the project. Okay. Preeti, can you please mute your mic?
Yeah, sure.
If you have any question, then you can unmute it. Okay. So that is the concept of relevant cash flow. Is this clear to you? Relevant cash flow concept. Well, we already did that in uh, previous class and
Yes.
management accounting as well. So that's your relevant cash flow. Now, third point. Unless the examiner told you otherwise, following assumptions are made about cash flows when calculating NPV. So these are the assumptions regarding the cash flows. Initial investment occurs at year zero today. The initial investment will be occurring today. Now, when you are studying all of this, whatever the concepts that we are going to study one by one, think of yourself as in that position. Like think of yourself as a finance manager. You are the person who's responsible for investing in the project, and for that you are working out all of this stuff. So think like that, then it will be better to grasp the concept. Okay, so initial investment occurs at year zero. Initial investment will occur at year zero. All cash flows occur at either start of the year or end of the year. Okay, we will assume that the cash flow is not going to be occur mid year. It will be either at very beginning of the year or very end of the year. Any cash flow at the start of the year is assumed to be occurred in the end of last year. Well, I told you this previously as well, that let's say you are making an investment on 1st January 2025. So from that is your year zero. 31st December 2025 and 1st January 2026 both will be considered as year one for the investment appraisal purpose. Okay, both will be considered as year one. So these are the few points that you should remember. Now the NPV format, you can see it's a like detailed format. It was not like that previously in the management accounting. The concept remains the same, but because now you are studying the financial management, you will be the finance manager. You have to make certain decisions regarding the project. So there are quite a few things that are involved in making that decision. Okay. Now previously the format, if you remember, was like it was left to right, but now it's top to bottom. Okay. If previously it was left to right, but now it's top to bottom. Now, the concept remains the same. The concept is same. NPV basically means what is the net benefit or net loss that you are getting from an investment in present value terms. So you can see at very beginning, I have write down the investment. Investment basically means what is the amount that you have invested in a project. And investment is always done at year zero. So that is why I have shown it in year zero with the obviously negative bracket sign. Bracket sign indicates that it is a cash outflow, right? Bracket signs tell you that it is a cash outflow. Investment. Then let's say from this project you are generating sales revenue for 4 years. You are generating the sales revenue for 4 years. So write down that in the relevant section. Sales revenue for year one, you are going to write it here. Sales revenue for year two, you are going to write it here. Sales revenue for year three, you are going to write it here. Sales value for year four, you are going to write it there here. Now then from the sales, the cost that are incurred from the sales, that the costs that are incurred, obviously when you invest in the project, when you get sales revenue, you spend some operational cost as well. It's not like if I spend $1,000 in the project now, and when the project has started, I don't need to spend any more cost. No, I do need to spend the cost on operational activities, etc., right? So whatever the cost are, variable cost and fixed cost, you deduct that from the each year. Okay. The from the sales revenue of the each year, you have to deduct the variable and fixed cost of those years. Variable and fixed cost of those years. Now remember, we are talking about relevant cash flows. So the fixed cost will be the incremental fixed cost. Incremental fixed cost means the additional cash flow that arises because of our decision to invest, not the complete fixed cost. Okay, because we are talking about only the relevant cash flows. So from the sales each year, you have to deduct the cost that you are incurring each year. For year one, two, three, four. Assume that in this case, because I have drawn the pro forma for 4 years, the project life is 4 years. So from sales, when you deduct the cost, you get the taxable cash flows. Taxable cash flows. From the sales, when you deduct the cost, you got the taxable cash flows, because you know that in business, in an organization, whatever you earn, you have to pay the tax on that. Whatever you earn, you have to pay the tax on that. So whatever your taxable cash flows are, like let's say your sales revenue for year one was $100. The variable cost for year one was $20, and the fixed cost for year one was $30. So your taxable cash flows are gonna be $50, which means you are paying tax on this $50. Let's say the tax is 20%, so the tax would be 50 times 20%, $10. Okay. So this is how you get the taxable cash flows. From the taxable cash flow, you have to deduct the tax. Whatever the tax rate will be given to you in the question, you have to multiply the taxable cash flow with that rate to get the tax payment for each year. Now, because the tax payment is cash outflow, when you pay the tax, it's normally cash outflow. So I have shown that in the bracket. Bracket means that this is showing the cash outflow. So each year's tax you have to deduct from the taxable cash flows. Okay. Is it clear up till this point?
Yes.
Could you please explain from the
Uh,
format again?
like from which part?
Um, from when, from the format, like this, from the start of the format, because
Oh,
my meeting got disconnected.
okay.
My Wi-Fi stopped
Okay.
working.
So this is the format for the NPV. Okay. In the year zero, you can see the investment. Investment is basically a cash outflow. So I have shown that in the bracket. Okay. Bracket means negative. Then let's say this project was of 4 years Purav. Okay. So every year's whatever the sales revenue that you are earning, write down the sales revenue of each year in this section. Sales revenue of year one here, year two here, year three here, and year four here. Then variable cost, whatever the variable cost or fixed cost that you have incurred during the year, you need to deduct that from the sales revenue. Because when you invest in the project, Purav, it does not mean that once you have done the investment, you have to like you need to spend no more cost. You spend the cost on the operational activities as well, right? So whatever the variable cost or fixed cost is, you need to deduct that. Let's say your sales revenue of year one was 100, variable cost was 20, fixed cost was 30. So you deduct that to get $50. That is the taxable cash flow. Remember, Purav, because we only take the relevant cash flow, so the fixed cost is the incremental one. Okay. Now, on the
Yes.
taxable cash flow, you have to pay the tax. You know that the business have to pay the tax on the profits, right? They have to pay the tax. So let's say your taxable cash flow was 50, and in the exam or in the question, the tax rate was 20%. So 50 times 20% gives you $10. That is the tax. So that tax payment, you need to deduct that. You need to do the working same for year 2, 3, and 4. So that is what we have done so far. Clear?
Yes.
Then there is WDA tax relief. Then there is written down allowance tax relief. Okay, this is the kind of tax relief that you get. Wait a second, this I think mistakenly I write on negative here. There's no negative here. Oh, sorry, that's not. Okay. Now from the tax, after deducting the tax, you are making an adjustment of working down allowance tax relief. Working down allowance tax relief. So tax relief, well, the word itself is telling you that you are getting some kind of relief, right? You are getting some kind of relief from the tax payment. Let's say your tax payment was $10, but you have got a relief of $6. So it means that you need to pay only $4, right? So 10 minus 6, 4. Uh, so that is a relief. Now, what is that relief? How do we calculate written down allowance tax relief? We will talk about that obviously step by step. In today's class, we are only going to discuss one aspect. This we will discuss in the next class, but that is some kind of relief. So remember, you are getting some kind of relief. And because it's a relief, Preeti, you can see that I have write down it's in the bracket. It's not in the bracket, okay? It's which means it's a positive cash flow for year one, year two, year three. But in year four, this relief can be either positive, it can be the negative as well. You can see here, I have write down both the situations. So we will discuss that how it works. But anyways, for now, you just need to understand that it is some kind of tax relief that you are getting. Now, how will it work? Let's say, Purav, your tax payment was $10. So from 50, you will deduct the $10. Wait a second. From 50, you will deduct the $10. So this and then on this $10 you are getting a tax relief of $4. So that $4 you will add it. So the net impact, Preeti, is minus 10 plus 4 minus 6. Net impact is that you're only paying $6 with respect to tax. Okay, so that is why we add the relief. Got it?
Yes.
Then comes the working capital. Then comes the working capital adjustment. Working capital is basically the investment in the operational activities of the project. uh, that is basically the working capital. And what is the working capital? How will we need to adjust that? We are going to talk about that. But here you can see the working capital is, I have shown that in the negative for year one, year two, year three. But for the last year, it's in the positive, which indicates that it can be a positive in what situation we will see. Working capital is basically the short term investment that you make in a project. Short term investment, short term spending in the project is known as working capital, which will be recovered in 1 year's time. Which will be recovered in 1 year's time. That is working capital. We are going to talk about the working capital in detail, but for here you just need to remember that okay, it's kind of like a short term investment which we will get back. So in year one we are spending it, in year two we are spending, in year three we are spending, in year four we are getting it back. Okay, how will it work in detail? We are going to talk about that. And finally, the scrap proceeds. When the project will be over, you can sell the asset for the project for scrap. And when you sell something, you get a cash inflow. So that is shown by this sign. So this is the maximum that can come in the NPV format of your course. Now, from taxable cash flows, when you will deduct the tax, when you will adjust the relief, when you will adjust the working capital, you will get net cash flow for each year. Net cash flow for each year. For year zero, because only the investment is done, so the net cash flow will be the same amount of the investment, because in year zero we only invest. And when you multiply the net cash flow with the discount factor, you know this concept, that whatever the future net cash flows are, when you multiply them with the discount factor, you get the present values of cash flows. You get the present values of cash flow. Discount factor obviously depends upon the percentage. What is the percentage that you are using? As per that percentage, you will go to the table and see what the discount factors are. And when you will multiply the net cash flow with the discount factor, you will get the present values of cash flows. And finally, you need to calculate the NPV. How will you calculate that? All of the future cash flows from year 1, 2, 3, 4, you will add them and then you will deduct the initial investment from them. Okay. Or you can simply, this because this is an initial investment, so you can simply sum from year 0 till year 4 because year 0 is in the negative. So it will automatically be net off and you can get the answer of NPV, net present value. So that is the format. Now we have to understand the workings of the format one by one. In today's class, we are only going to talk about the cash flows, real cash flows, and nominal cash flows. Obviously, in upcoming classes, we are going to talk about tax and tax relief. Then we will talk about the working capital adjustment. Any question that you both want to ask, you can ask so that I can move on. Anything you want to ask?
No, sir.
No.
Okay. Now let's start with our first adjustment of this format, that is inflation adjustment. Inflation adjustment. Now here you can see two types of the cash flows that I have mentioned. Real cash flows and money cash flows. Remember that the previous word for the money was nominal. Previously, the nominal word was used by the examiner, but now they are using the word money cash flow. So if you see nominal cash flows word here in my notes, so it means that I am talking about the money. Okay, whatever there is a nominal, it means money. So you don't need to get confused. Okay, it means the same thing. Now in the there are two types of NPV. You can calculate the NPV using two methods. You can calculate the NPV using two methods: real method and money method. You can calculate the NPV using real method and money method. Okay. Now, before going with there, first you have to understand the type of cash flows. There are two types of cash flow: real cash flow and money cash flow. Real cash flow are the cash flow which do not have the impact of inflation, which do not include the impact of inflation, and they are in current price terms. They are already in current price terms. There is no impact of inflation. There is no impact of inflation in that cash flows. Such a cash flows will be known as real cash flows. Those cash flows will be known as real cash flows. Now, let's say there's a cash flow of $100 and it's in the current price term. So I will say it's a real cash flow. And when you will include the impact of inflation in it, it will become the money cash flow. Let's say the inflation was 10%. So 10% of 100 is $10. So now the money cash flow, you can say it's $110. So that is basically money or nominal cash flow. So money cash flow is the cash flow that includes the impact of inflation, and real cash flow is the cash flow that do not include the impact of inflation. First point. Is this point clear to you both?
Yes.
Pretty clear?
Yes.
Okay. Now, when you will calculate the if there's a real cash flows in the question and you need to calculate, then the NPV is calculated by the real method, or you can say that if you are calculating the NPV using real method, so these real cash flows you need to discount them with the real cost of capital that will be given to you in the question. Okay, let's say in the question it is mentioned that real cost of capital is 8%. So Preeti, when you will calculate the NPV, so the discount factor that you will use here in this format, you are going to use the discount factor according to the 8%. We have the format here, so we have the table here. So by looking at the table, whatever the percentage is, you will follow the discount factor for those percentage. And if you are calculating NPV using real method, you have to take the real cost of capital to discount it, to discount the obviously future values into the present value. Similarly, if money cash flow is in the question and you have to calculate the NPV using money method, then you have to discount the cash flows with the money cost of capital. Discount the cash flow with the money cost of capital. Cost of capital is that interest percentage. You both know it. It's the interest percentage using which you calculate the discount factor and then you use the discount factor to calculate the present value. So for money cash flows, you have to use money cost of capital and NPV will be known as per money method. And for real cash flows, you need to discount them with the real cost of capital. Okay, clear? This These points are clear?
Yes.
Yes.
Okay.
Yes.
Now, second point, to convert real cost of capital, if in the question, let's say real cost of capital is given to you and you want to calculate money cost of capital, you can do that by using this. You can do that by using this formula, which is 1 plus I is equal to 1 plus R multiplied by 1 plus H. Okay, Purav, you can mute your mic. If there's a question, you can unmute it. So 1 plus I is equal to 1 plus R 1 plus H, where I means money cost of capital, R means real cost of capital, and H means general rate of inflation. General rate of inflation. So if let's say you are provided with the real cost of capital and general rate of inflation, you can work out the money cost of capital. You can calculate the money cost of capital. Inflation is of two types, general rate and specific rate. General rate means the inflation that impacts all. Let's say I say there's a 10% inflation. Okay, so 10% inflation means that your selling price will increase by 10%. Let's say your variable cost will increase by 10%, your fixed cost will increase by 10%. So that's a rate applicable to everything. Specific rate means that a specific, like let's say in the question, it will be mentioned that your material cost will increase by 10%, 12%, your labor cost will increase by 8%, 13%, whatever that is. So these are known as specific rates. Okay. So here in this Fisher effect, you use the general rate of inflation to calculate the money cost of capital. So that's it. Now, I will advise you both to keep a register with you, when we are doing the question, so you can like write down the formulas which we will so that when we attempt the question, you have some idea about that. Anyways, so that was it for the inflation. Now, uh, this point I have mentioned here. Cash flows in exams are assumed to as money cash flows unless told otherwise. So in the question, when you see a cash flows, if it's not mentioned that they are real cash flows, if nothing is mentioned, you will assume that these are money cash flows, which means that they include the impact of inflation. So this was our first adjustment. Any question you both have, you can ask so that I can move to the question. If you have any
Yes.
problem.
No.
Okay, now let's understand this directly with the few examples. So let's discuss. So first question. Storm company is evaluating project X, which requires initial investment of 50,000, expected net cash flows. Net cash flows means that this net cash flow figure is already given to you here. This one, net cash flows. So you don't need to like do all of this because they have directly told you what net cash flows are 20,000 per year for 4 years at today's price. So if they are at today's price, so which type of the cash flow they are? Real or nominal or money? If this 20,000 is at today's price, current price terms, so what type of cash flows are these? Real
Real.
cash, yes, real cash flows. Real cash flows are those which do not include the impact of inflation, right? We just talk about it, which are according to the current price terms. So they are real cash flow. However, these are expected to be rise by 5.5% per year because of inflation. So inflation rate is also given to you, that is 5.5%. The firm's money cost of capital is 15%. So money cost of capital is already given to you. You have to calculate the NPV by discounting money cash flows and by discounting real cash flows. So it means that you have to calculate the NPV using both methods. Okay. So let's start. So what is the life of the project? 4 years. So I'm gonna draw here 0, 1, 2, 3, and 4. So investment is done at which year?
Zero.
And what is the amount of investment?
20,000. No,
What is
50,000.
50,000.
50,000? 50,000. So in 0. So now here you can see in the format there's a variable cost, fixed cost, then taxable cash flows, then net cash flows, all of the other stuff, and then net cash flows. But because here you both can clearly see that the net cash flows are already given to you, so you don't need to like work all of the stuff because the net cash flows are given to you, so you can directly write net cash flows. Okay, so net cash flows are how much year each year?
20,000.
20,000. 20,000, 20,000, 20,000, and 20,000. Now we have to multiply. Okay, after once you have got the net cash flows, you multiply them with the discount factor. So let's do that. Multiply them with the discount factor to get the present value. What will be the discount factor at year zero?
One.
And
One. One. Year zero is one because 50,000 invested today are equal to 50,000 today. Now, first let's do the NPV real method. Okay. Uh, NPV real method. So for doing NPV real method, which cost of capital do you need? I am
The
doing
net cash flows.
which cost of capital do you need? There are two types of cost of capital: real cost of capital and money cost of capital. So if the cash flows in the question are real cash flows, which cost of capital do you need?
Real.
Real cost of capital. Obviously, the name itself is telling you. If the cash flows are real, real cash flow means they do not include the impact of the inflation. So the cost of capital should be real. But in the question, which cost of capital is given to you?
15%.
Which cost of capital is given to you?
1,515.
I'm not asking about the number. Which type of the cost of capital is given to you?
Money cost of capital.
Money cost of capital is given to you. And for real method, which cost of capital do you want? Real cost of capital. So it means that you have to convert the money cost of capital into real one. And what was the formula here? Fisher effect. 1 plus I is equal to 1 plus R, 1 plus H. I'm going to do it here separately. 1 plus I means money cost of capital, which is 15% in this case, so 0.15. Now here you need to calculate this R real cost of capital. So this bracket on the other side of the equation, you will divide it. You will divide it on the other side of equation. So 1 plus H, you will divide it, and H means the general rate of inflation. What is the rate of inflation in the question?
5.5.
So 0.055 is equal to 1 plus R. R is what you need to calculate. Now you have to use the calculator. 1 plus 0.15, 1.15, and then wait a second, 5.5 divided by 100, 1.055, yes. Zero. Well, you have to do as well. You do it, do your calculation as well. It's 1.090, this one, 1.090, and 1, you have to take it on this side of equation. So minus 1 is equal to R. So the answer is 0.090, and if you multiply that with the 100, you will get the 9%. So R, the answer of R is 9%. If you want to convert the decimal into the percentage, just multiply that with 100. So here you will get the real cost of capital as 9%. Do the calculations yourself as well. You both should have the scientific calculator with you. We are doing the calculations. So this is how you convert the money cost of capital into the real cost of capital, which is 9%. Is this clear?
Yes.
Yes.
So it means that the discount factor you have to use at 9% for the real method. So let's move on to the table. And at 9%, the discount factors are in front of you: 0.917, 0.842. So I'm going to write them here: 0.917, 0.842, 0.772, 0.708. So present value for year zero, well, it's gonna be 50,000 negative. What will be the value for year one? What will be the present value for year one?
18,340.
Yes, tell me for year two. Purav, I want your involvement as well.
16,840.
16,840 for year three.
Yes.
15,440.
For year four,
14,160.
14,160. So this is the present value. Now you can calculate the NPV by summing them all. So, well, minus 50,000 plus 18,340 plus 16,840 plus 15,440 plus 14,160.
14,780.
Okay, so minus 50,000. Purav, you can confirm if it's right or not. 18,340
Yeah.
16,840 plus 150.
14,780.
Yes, so 14,780 positive, positive 14,780. So should you invest in the project or not?
Yes.
Yes.
Yes, because the answer is positive. So that was NPV real method. In real method, you should have real cash flows. Real cash flows are those cash flows which do not include the impact of inflation, and you discount them using real cost of capital. In this question, the money cost of capital was given to you, but no problem. You know the formula for the Fisher effect, and using that formula, you calculated the real cost of capital. And you use the discount factor at that real cost of capital to get the real NPV. Is this clear?
Yes.
Yes.
Is the formula clear that how I calculated the real cost of capital using the money and the inflation rate?
Yes.
Okay.
Yes.
Now the second requirement is to calculate the NPV using money cash flows. Okay, so let's do that. You guys can keep your mic mute. When I will ask you, you can unmute because there's a distortion from one of your mic. So now NPV using the money method. So again, year zero, year one, year two, year three, year four. So investment is 50,000 and net cash flow, discount factor, and then present value. Okay. Now tell me which method are we using? Which method are we using now? Which method of NPV are we using?
Money cash flow.
Money method. Money method. And for money method, we need which type of cash flow?
Money.
And money cash flows are what? That includes the impact of inflation or
Nominal.
that do not
Yes.
include? That includes, right?
Glutes.
That
Yeah.
Yes.
includes. So it means and the cash flow that are currently given to you, are those money or real?
Real.
So it means you need to inflate those cash flows. You need to inflate those cash flows. And you know the inflation rate. What is the inflation rate?
5.5.
So it means that you have to
5.5.
increase the cash flow by 5.5% every year. Is this point clear?
Yes.
Yes.
Okay. So the cash flow for the first year will always be 20. Well, it will be 20,000. Then for the second year, you have to increase it. How will you do that? It's very simple. 20,000 multiply by whatever the inflation, 1 plus inflation rate, whatever the inflation rate is, which is 5.5%. So it will give you 1.055. Well, you can do that on your calculator as well. 1 plus 5.5% will be 1.055. Power 1, because you want to calculate, you want to inflate it. So then 20,000, similarly, 20,000 times 1.055 power 2 and onwards. Okay, and ons. Oh, sorry, well, for the first year, or well, you will inflate it for the first year because these are the these are as per today's price, right? So this is how you do that. For third year, you will do 20,000 times 1.055 power 3. Well, in the management accounting, there was a formula for calculating the future value. Remember compounding. That was present value multiplied by 1 plus r power n. So you can use the same formula here, that you want to inflate this cash flow. So 20,000 multiplied by 1 plus r here means inflation rate, which was 5.5%. And if you want to calculate for 1 year, power 1, for 2 year, power 2, for 3 year, power 3, for 4 year, power 4. Is this clear?
Yes.
So 20,000 times 1.055 is 21,100. Tell me for the year 2. 20,000 multiplied by 1.055 power 2. So 2 to 22, 260. Then 20,000 times 1.055 thousand times 1.055 power 3.
23,484, 485,
23, yes, 485. And then 20,000
20,
times 1.055 power 4.
24,776.
24,776. Yes, 24,776. So this is the money cash flows. Okay, we have to inflate them. Is this part clear so far? Any question you want to
Yes.
ask, you can ask. And because these are now money cash flows, so we need to discount them with the money cost of capital, which is 15%. So let's do that. At year 0, discount factor is 1. At year 1, let's see what's the discount factor. 15%. Year 1, 0.870. 0.756. 0.658. 0.572. So present value 50,000. So what will be the present value for year 1?
1827.
Well, it will not be 1827. 21,100 times 0.870.
18357.
18357 for year 2.
16,829.
For year 3.
15,453.
For year 4.
14,172.
Okay, now calculate the NPV. Present value of future cash flow minus initial investment. So it means negative 50,000 plus, whatever the future cash flows are. It means the same thing. Sum of all like values.
14811.
14811. So they are, if you look at this carefully, both of the NPVs are almost close to each other, right? Almost close to each
Yes.
other. So whether you use real method or you use money method, both of the answer of the NPV will be almost similar. Okay, will be almost similar. In both situations, you can see the gap is not that much. So the point that you should understand is that if there are real cash flows, you discount them with the real cost of capital to get the real NPV. If there are money cash flows, you discount them with the money cost of capital to get the NPV as per the money method. In the question, if it is not mentioned about the cash flows, that whether they are real or not, you are going to assume that they are money cash flows. Here, Preeti, in the question, it was mentioned the cash flows are at today's price, which means real cash flow. Real cash flows are those which do not have the impact of the inflation and are in the current price terms. Current price terms and today price means the same thing. So this is what you need to understand. Anything you want to ask? Any question if you have?
No.
Okay. Now the last question of the today's class, and before that I'm going to go to the notes again. I have told you that there are two rates of inflation. One is general rate and second is specific rate. General rate means which is applicable as a whole. Like let's say in the first question we use the inflation rate on the net cash flows. Net cash flows means that already sale from sales, variable cost, fixed cost, tax, everything is adjusted, right? But if you are performing the calculations of each of this stuff individually, separately, and specific rates are given to you. Specific rate means you are told that okay, the variable cost will inflate by this percentage, the inflation rate of the fixed cost is by this percentage. Then you have to use those specific rates to inflate them. Okay, that's those specific rates to inflate them. In the Fisher effect formula, the general rate of inflation is used. Remember, that's it. But to the for those specific cash flows, you have to use the specific rates. Is this point clear to you both?
Yes.
Yes.
Okay, so now help me with this last question. Uh, okay, so the last question is in front of you. A company, well, this second question is your homework. You guys can do it on your own. I will share you the file. It's same as first one, so no point of doing it again. Now, this last question we are going to do. A company is considering a cost saving project. This involves purchasing a machine costing 7,000, which will result in the annual savings in real terms on wage cost of 1,000 and material cost of 400. So by doing an investment, you are getting a saving of the wages of 1,000 and material of 400. So these savings will be your cash inflow. The savings that you get from the project is your cash inflow. It's the benefit that you are getting, right? And these figures are given to you, Purav, in the real terms. It's mentioned. The following forecasts are made at the rate of inflation. Inflation rates are given to you. For wages cost, inflation is 10%, material cost 5%, general rate is 6%. The cost of the capital of the company in real terms is 8.5%. The cost of capital in real terms is 8.5%. Evaluate the project assuming that the machine has a life of 5 years and no scrap value. So now you have to evaluate the project by assuming that the machine has a life of 5 years and it has no scrap value. So now let's start. So again, the project life is 5 years. So I'm going to write the details here: year 0, year 1, year 2, year 3, year 4, and year 5. Let's start with the real method of NPV first. So, okay, help me with that. What will be the investment? Tell me the investment.
7,000.
7,000. Okay, 7,000. Then you are being given with the two cash flows. One is the wages saved, and material cost saved. You you cannot see any fixed cost, any variable cost. There is no cash outflow given to you. Okay, no problem. No given, not given, no problem. So it means these are my cash flows. Okay. So first of all, we let's say if we use the real method, if you would have used the real method, what would be the cash flows that we would have used? Simple: 400, 1,000 for the wages every year, and 4,000 for the materials, for the 4,000 for the material, right? And then we could have
Yes.
performed the calculation using 8.5% cost of capital, right, Preeti?
Right, sir.
But here we don't need to do that. We can, like we know how to work it out. So let's do NPV using nominal method directly. Okay, the one that we need to understand. Okay, let's do that. So now for the nominal method, we need the nominal cash flows and we need the nominal cost of capital. In the question, I am being given with the real cost of capital, but no problem. I know the Fisher effect. I know how to calculate the nominal cost of capital or money cost of capital. If I use the term nominal, it means money, because last time it was nominal. Now it's called money. So that's why I can mix the words, but means the same thing. This is the formula that is given to you: one plus I. I means money cost of capital. You need to calculate one plus R plus one plus H. So uh, 1 plus I. I means money cost of capital, which you need to calculate. 1 plus R. R means the real cost of capital. What is the real cost of capital in this question?
8.5.
So 1 plus 8.5. 1 plus inflation rate, general rate of inflation. What is the general rate of inflation?
6%.
6%. So tell me the answer of this. 1 plus 0.085. 1.085 times 1.06. It's 1.1501, right? And from this 1.1501, because I need to
Yes.
calculate I will deduct this one on the other side of equation. So this will give me 0.1501, or in the percentage, it would be 15%. To convert the
15%.
decimal into the percentage, is 15%. So it means that your discount factor will be at 15%. Pretty clear how did I calculated the money cost of
Yes.
capital?
Yes.
Okay. Now we are calculating NPV using money method. So I need money cash flows. So my question to you both is, tell me what will be the wages saved for year one, two, three, four, five, and material save as well. So tell me what will be that. How will you calculate that? What do you need to do? We are using NPV money method. We are doing NPV money method.
Cash flow add with it the inflation.
Yes, we need to inflate the cash flows. Okay, Purav, because we are using money method of NPV. So obviously we need money cash flows, right? And for money cash flows, we need to inflate them. These cash flows that are given to you are in the real terms, but now you have to inflate them. How do you inflate them, Preeti? By multiplying them with the inflation rate, right?
Yes.
Now, which inflation rate will you use for the wages saved? First, we are talking about the wage cost. So, which inflation rate are you going to use?
15%.
Well, I cannot see the 15% anywhere.
Oh, sorry.
10%.
10%.
Oh,
10%. Look, it's mentioned now. Okay, I told you just before question, this question. I told you that if the specific rates of the inflation are put up given to you, you have to use those, right? The general rate you have to use in the Fisher effect formula. Okay. If in the question the specific rates are given, so inflate the cash flow using the same rates. So tell me, Pulav, how will you inflate the cash flows? First, tell me how will you do that for the wages?
Uh, 1000 times 10%.
Well, I just told you a formula: 1,000 times 1 plus r power n, where r means the rate and n means number of years. So what is the rate by which you need to inflate?
10%. So
So
0.1.
0.1 power 1. You will do power 1, you will get the answer for. You will do power 1, Preeti, you will get the answer for year 1. What's that? I think it would be 1100.
yeah.
Then if you use power 2, you will get the answer for second year. What will be that? 1000 times 1.1 power 2. What will be the answer? Well, you don't have scientific calculator with you. I think you are using both of you using a mobile calculator.
No,
What's
no.
the
1210.
for year 3,
1331.
for year 4,
1464.
for year 5,
16105.5.
16?
10.5.
Okay, 10.5. This formula is simple for calculation. Inflation basically means every year you have to increase the cash flow by 10%. So 1000 increase by 10%, you can simply multiply 1000 with 1.1. Then for year 2, you can multiply 1100 with 1.1. For year 3, you can multiply 1210 with 1.1. You will get the same answer, but I think it's
Yes.
preferable to use this formula. Okay. The concept should be clear. Okay. You can continue with any method you want. Now for the material cost, what is the rate of the inflation that you are going to use?
5%.
5%. Okay. Tell me what will be the cost saved? For the first year, what will be that?
four 420,
For the second year,
441,
for third year,
463,
for fourth year,
486,
for the last year,
510.
510. So these are your savings. Savings, Preeti, are cash inflows. Okay, Purav, savings means cash inflows. So what will be your net cash flow? Just add these two. Net cash flow means cash inflow minus cash outflow. So there is no outflow here. So just add them. Simple. No point getting confused. So what will be the net cash flow?
1520.
For year zero, it's gonna be 7,000 negative because in the year zero, well, there's no year zero. Year zero reflects present value, but that's the 7,000. Then what's that? 11,420, 1520. Then for year two, 1 to 10.
1520.
For year two,
1651.
for year three,
1794.
for year four,
1950.
for year five,
Is that
0.5.
1610.5?
It's 1610.5. So it will be
2120.5.
okay. 2,121. I will write here. Now you need to discount them by 15% for year zero. Discount factor is always 1. Now let's write down the discount factor at 15%, 0.870756, 0.870, 0.756, 0.658, 0.572, and for the last year it was 0.497. Okay, now multiply. It will be negative 17,000. What will be the present value for year one?
1322.4.
Okay, 1322 for year two,
1248.
1248 for year three,
1180.
1180 for year four,
1115.
for the last year.
1054.
Okay, now you have to calculate the NPV. Tell me what the NPV would be.
Negative 1081.
So, will you invest in the project?
No.
Priti, you can also confirm the answer if it is right.
Yes, sir. 108.
So, it means that you don't need to invest in the project. So, this was your NPV. In today's class, we only discussed about the inflation method. Now, the last point that I have mentioned here, let's go through that and finish the class. Here, this last point. If in the exam both the general rate and specific rate are given, inflate the figures using specific rate to get the nominal cash flows, like we just did here in this question. Because general rates and specific rate both is given. General rate 6% is given, specific rate means specific to that term, like wage and material cost, it's given. So we use the wage rate, the specific rate to inflate the specific cash flows, right? Is this part clear? That is what you need to do. Clear?
Yes.
Yeah.
But the second point is very
Yes.
important. And deflate the nominal cash flows using general rate to get the real cash flows. If you were given with the nominal cash flows, if you were given with the nominal cash flows in such type of questions, like here the cash flow was real, okay, real was given here, real. But if in this similar question, if in this question, let's say the nominal cash flows were given to you and you have to calculate the real cash flows. So in that case, you have to deflate them using the general rate, whatever the nominal cash flows are, you have to deflate them using the general rate of inflation to get the real cash flows. We will do a past paper question regarding this as well, but you need to remember this point, okay? That if in the question general rate and specific rate both are given to you and nominal cash flows are given to you, and if you want to convert them into the real cash flows, you have to deflate them. Deflate means removing the impact of inflation using the general rate of inflation. As for the fixed cost,
Yeah.
I told you that irrelevant fixed cost is not considered. You have to consider the relevant fixed cost and inflate that because only the relevant cash flows are considered.